Welcome. In this video, you're going to learn something really valuable that could totally change how you think about investing. And hey, if you find this useful, do me a favor and hit that subscribe button and like the video so you don't miss out on what's next.
All right, let's just jump right in with a big question. When you think about investing, what do you think actually matters more in the long run? Is it about making those brilliant once-in-a-lifetime stock picks? Or is it just about not making huge game-ending mistakes? We all love the idea of a home run, but you know what? The real key to winning might be something a lot less flashy.
So just so you know, this is actually our 10th class in our series on investment basics and wealth creation. If you're new here, you can catch up on all the prior classes in our playlist called Investment Decisions. And you'll definitely want to stick around to the end of this one, because I'm going to give you a super useful summary checklist that ties all of this together.
This quote right here is the core idea for everything we're about to talk about. Seriously, think about a tennis match. The amazing, impossible-looking winning shot is what gets on the highlight reel, right? But what usually decides who actually wins the whole match? It's the unforced errors. It's the simple mistakes. The player who makes the fewest of those is almost always the one who comes out on top. And as we're about to see, investing is, well, it's a lot like that.
Okay, so let's get into it. Let's break down the first group of these investing unforced errors. These are the mistakes that are driven by our emotions. Getting caught up in the hype, hoping for a miracle, and that powerful temptation to swing for the fences.
The first, and maybe the most classic mistake, is swinging for the fences. It's that all-too-common urge to dump your money into some super risky, speculative stock, hoping you've found the next big thing. But here's the problem. The math of losing money is just brutal. I mean, think about it. If your stock drops by 50%, you don't just need a 50% gain to get your money back. No way. You need a 100% gain. It has to literally double just to break even.
And check this out. This is where the data gets super interesting. We're always told that these small, risky growth stocks are the ticket to getting rich, right? But history, well, it tells a very different story. If you look at the data going all the way back to 1927, these stocks have averaged about a 9.3% annual return. The S&P 500, which is just 500 of the biggest companies in the US, has actually done better, returning 10.7%.
Now, I know what you're thinking. A 1.4% difference sounds tiny. Who cares, right? Well, this is the magic, or the tyranny, of compounding interest. Over 30 years, that tiny little gap on just a $1,000 investment turns into a $7,000 difference in your bank account. That is the real cost of chasing those high-risk bets. It really adds up. And that brings us perfectly into our second unforced error, which this legendary quote captures so well. Believing it's different this time is one of the single most dangerous traps an investor can fall into. And it's a mistake people make again and again and again, usually right before a massive market bubble pops.
I mean, just look at the history books. In the spring of 2000, during the dot-com bubble, the story was that these new tech stocks couldn't lose. They'd go up forever, right before they completely crashed. Then, just a year later, the hype shifted to energy stocks. They were the sure thing, right before they tanked. See the pattern? It's a classic cycle.
Okay, mistake number 3. This one is so easy to make. We fall in love with a product that we use every day. Let's talk about the Palm Pilot. It's a perfect case study. If you remember these things, they were totally revolutionary. Everybody had one. It felt like such an obvious, can't-miss investment. But, and this is a huge but, here is the critical lesson. A fantastic, popular product does not automatically mean it's a fantastic, profitable business. The world of consumer electronics is just brutal. You've got insane competition and paper-thin profit margins. Millions of people absolutely love their Palm Pilots, but the company, the business behind that cool gadget, was really struggling to make money. And here's the painful result. From its peak in early 2000, Palm's stock absolutely collapsed. It fell by over 98%. It's a tough lesson, for sure, but a really powerful one. You have to invest in the business, not just the product you love. All right, let's switch gears a little bit. We've talked about the mistakes that come from hype and hope. Now let's dig into the errors driven by the other side of that emotional coin: fear and, well, just bad analysis. This brings us to mistake number 4, panicking and selling when things look bad. Our natural human instinct is to run for the hills when everyone else is scared. But as the legendary investor Sir John Templeton famously said, the point of maximum pessimism, when things look the absolute worst, is actually the very best time to buy.
Widespread fear creates incredible bargains for those who are brave enough.
And once again, history gives us these perfect examples. Back in 1979, a huge magazine ran a cover story titled The Death of Equities. You know what happened next? The market went on an incredible 18-year bull run. Then, in 1999, right at the peak of the tech bubble, another magazine ran a cover asking if Warren Buffett had lost his touch for avoiding tech stocks. We all know how that story ended. Being brave when others are fearful really pays off.
Okay, mistake number 5 is a big one. It's listening to that tempting siren song of market timing. The idea that you, or anyone, can perfectly predict when to jump in and out of the market. It sounds amazing, but the data is just crystal clear. One study found that even if you had a perfect crystal ball to see the future, 2/3 of market timing strategies would still lose to a simple buy and hold approach.
And there are 3 really simple reasons it's a losing game. First, when you jump in and out, you totally miss out on the awesome power of long-term compounding. Second, most of the market's gains happen in just a handful of really good days. If you're sitting on the sidelines for those days, you miss almost all the profit. And third, just think about it. If this were actually possible, some professional mutual fund would have perfected it by now. Not one has, ever.
Now, the 6th mistake is a bit more subtle, but it is absolutely crucial. It's ignoring what a company is actually worth. You really have to ask yourself an honest question. Am I buying this stock because I've done my homework and I truly believe the business is undervalued? Or am I just buying it because I hope some greater fool will come along and buy it from me at a higher price later? That second path, my friends, that's not investing. That's just gambling.
And here we are, our final unforced error, focusing only on a company's reported earnings. Here's the secret. Earnings numbers can be played with. They can be manipulated through all sorts of accounting tricks. But cash flow, the actual real cash moving in and out of the company, that is much harder to fake. Cash is the lifeblood of any business, and it tells you the real story of how healthy it is. So there you have it. We've gone through the 7 most common and most costly unforced errors in investing. Now, just like I promised, let's put it all together into a simple, practical checklist you can actually use to stay in the game and win it. All right, get ready. Here is your championship checklist. Number 1, focus on solid companies at low valuations. 2, understand market history. 3, check the business model, not just the product. 4, use fear as an advantage. 5, don't try to time the market. 6, pay careful attention to valuation. And number 7, trust cash flow, not just earnings. And that brings us full circle, right back to where we started. After looking at all these common mistakes, the real question for you is this. What game are you actually playing with your money? Are you constantly trying to hit those spectacular, flashy winners? Or are you playing a smarter game? Are you playing not to lose? The answer to that question could make all the difference in the world.